Ahoy there, traders. How are we all doing? Welcome one, welcome all. Thank you again for taking a moment out of your day to spend it with little old me. Hey, Randall, how you doing? Hey, Loy, Steve, Scott, Vito. Just a small group this week. I'm sure everyone will start to rock and roll up as we get going. So let's dive right in. Option strategies made simple. Now, don't worry, we won't need the abacus. We don't need to take shoes and socks off today. I'm just going to go through a really simplified version of how I like to trade using options. And we're going to compare a stock option with stock. And hopefully by the end of this brief introduction, you will be convinced if you're not already. So, one or two people still coming in. If you are new, the way that these agendas or the way these workshops go is we tend to ruminate on the markets for 20 to 30 minutes and no longer than about 60, unless I'm rambling and ranting like last week. We'll have a little look at the markets, and ultimately we're going to look at options made simple. For anyone who is new to these sessions, you can read the list of things right there. You know, I've been doing this for quite a period of time. I've been trading full time since 2001. And, you know, rather than just read it out like I do most weeks, let's just focus on the thing that is most important. I've coached thousands of students with my programs. That's the thing that's most important to you right now. I've personally mentored 756 traders. And from retail through to banks, hedge funds, owners, institutions. That number is constantly going up and up, but that's basically just since I last updated the slide. I love a good read with a good coffee usually. That's usually where you can find me. I tend to spend a lot of my time relaxing. Contrary to popular belief, you don't need to spend all day flicking through chart after chart after chart, and that's what I like to teach you here. Now, I'm not a Wall Street guru. I'm just a regular guy who's figured out a few things and want to help you see your success. So every week, I personally help you and try and be your swing trading mentor. Every week, I give you no bullshit inside information on how to find and profit from swing trading stocks so that you can create wealth and basically live your best life. And it's that last part that's most important to me personally. Live your best life. You know, we don't want to be glued to the screen and glued to the monitor. And it's not just me saying it because it's a nice, fancy, sexy thing to say. My students say it as well. It's easy to follow. It's profitable. It's simple to replicate because I've cracked the code on my own production line trading. And it's not an isolated instance. You know, I have lots of student successes, and these are from, you know, just some recent conversations. It gives me time freedom. It gives me financial freedom. I don't have to worry about what I'm doing, when I'm doing it, why I'm doing it. I get to choose all of those things because it just works. Recently, I've taken to be a little bit of an urban rambler. I'm basically just going sightsee around my local area now that our official lockdown is over. Again, all because it gives me production line trading gives me time freedom and financial freedom. So that's what I'm hopefully trying to share with you today. At the very least, give you some inspiration that it can work. It does work. And if you find the right system for you, and I'm not naive enough to think that my way is the only way. I just know that it works for me. And if you're looking for a simple system that you can zero in on swing trading stocks without spending hours wondering where the next chart is doing a complicated version of the stock market equivalent of Where's Wally, then you know this might be for you. Anyway, what we're going to focus on this week is option strategies made simple. So there are 5 main option strategies that I teach all my students. And what we're going to do today is we're going to run through the one that I most commonly use. So obviously, because I use it more than most, it is my most profitable strategy. Before we look at that, let's just look at the traditional way of trading the stock trade. And this is Twitter. We've been following this for several months now as our model trade. And the last one fired off just a few weeks ago. Now, if we'd placed that trade with stock, we would have been entering around about $55, basically above 53, but you know, let's just call it 55 for the entry. We'd have a stop loss below the lows at about $50. So we're risking $5. and target usually is going to be a retest of the highs. And that would be pretty standard, pretty simple strategy, buy the dip essentially. So that is your classic stop trade, your entry, your stop loss, and your target. And I would hope that you do use stop losses. I've had conversations recently with people who don't feel the need to use a stop loss. And that's great if you're an investor. But if you're a trader and you're profiting from the swings in the market, then you do need to be a little bit more proactive on the management side. If you're an investor, it's less important because you've got a multi-year, maybe even a multi-decade approach, or maybe a different style of trading would be, say, for dividend payments. Again, there's different horses for different courses, essentially. I'm a swing trader. I profit from the ebbs and flows back in the markets. I don't really care what the company does. I just want to make money from the movement. So entries, stop losses, targets, they're the three elements. Now, if you're trading stock, you are going to have a margin requirement in most cases, unless you've got a cash account or an IRA account if you're in the US. So there are some extra requirements beyond the risk. So while there is a $5 per share risk, and let's just say we've got 100 shares so we can compare it to the option in a moment. So you're going to risk $500. And if the trade works out, you're going to make $2,500, which is all great and fine and dandy. Now, if you've got a cash account, you need to times $55 by 100 shares to get your capital requirements for the trade, $5,500. If you're on a margin account, it's usually around 25%. And obviously, these things fluctuate in ebb and flow. If the market crashes and goes crazy, the margin requirements will change. And basically what margin requirements is the best way of thinking about it. It's like getting a discount on the cash that you need to hold the trade. Again, we're using 100 shares as our example. So we need $5,500, but on a margin account, we get a discount. We only have to put up 25% of that amount. Now, the mistake that people, I'm just going to take a little, I wasn't planning on this, but now I'm kind of talking through this. It's worth mentioning where people go wrong with margin. It's not a bad thing. It's not a scary thing, although it is the reason why people were jumping off buildings in 1929, because they leveraged their position. What people will do is say, well, previously I needed $5,500. I'm just looking at these numbers here. Previously I needed $5,500, but on margin, I only need 25%. So you can start to multiply the positions, 2 or 3 or 4 times. So instead of 100 shares, people might trade 300 shares to still have that same capital requirements. But if you're doing that, then your risk times 3 as well. So that's the mistake that people make. They use it as a multiplier instead of seeing the trade. I get the trade at a discount. Is the point. And I'm gonna know we're all smart people here. I know you all get that, but it's worth pointing out. So we focus on, if we've got a margin, we get the trade from a capital point of view at a discount, a 75% discount. That's what margin to me means. I don't have to put up all the money. So a little bit of a meandering sidebar. I think it's worth just pointing the obvious out. So I'm not going to leverage my position as the point. I treat margin like it's a discount. And that's the best way of thinking about it. So anyway, 100 shares, I'm going to need about $1,375 to carry the position, is often how it's phrased. And again, you can go to your broker websites and it will tell you what your specific margin requirements are. This is what it is for me because I'm in the UK trading the US markets. If you're in the US trading US markets, you might have some exceptions. You might have some additions. Check it out for yourself. So margin requirements. Now, with an option for the same $500 risk. So we're going to trade 100 shares. So one option is controlling 100 shares. So I'm still going to risk $500. And that risk is in the price of the option. So if options are brand new to you, the best way of thinking about it, if today's the first day that you've ever thought about them, It's just like a deposit. In the real world, you come across them all the time. Instead of buying 100 shares, I'm going to place a deposit on 100 shares and reserve them. We would do this in department stores. We do it online, click and collect, do it on Amazon. We do it with cars. The usual metaphor I give is the car example. If I go to a car showroom, I'd want that car, that specific car that's in the forecourt. Don't sell it to anyone else. Certainly, Mr. Buyer, the car dealer will say, just leave 10% deposits. So I only need a fraction of the amounts of what I actually need. And usually it's around 10%. It fluctuates, obviously, there's a few variables that go into it. But the point is it's not weird, it's not scary, and it's nothing new. You've come across these things many, many times before. So 100 shares or one option is the same thing. Instead of buying 100 shares, I can control 100 shares. I can still risk $500. And for my $500, I can control 100 shares. So the price of my option is going to be $5 per share. That's what it was. That's what it is on Twitter right now. The at the money option is about $5. There's a few pennies either side of that. Again, I'm just rounding off for simplicity so we can compare both of these side by side. So the main difference here is, and why I really like stock options, is I've got a capital saving. So it's more capital efficient. So in a cash account for stock, you need $5,500. But with the option, I just need the $500. My risk is $500. My cost is $500. So straight away, there is this capital saving. There's no margin as such. So my risk is $500. My capital is $500. So I have this capital saving straight away that I can do something else with. And when you've heard me in past sessions saying trade frequently, this is one of the things that allows me to trade frequently because I'm freeing my cash by not trading the stock, the underlying. Then I can put 3 trades on with the same money. I'm not saying put 3 trades on Twitter, but if I find 2 other trades, I can be more effective and more efficient with the capital that I have. And this means that if you are at the smaller account spectrum, the smaller account size, then this means that it's great. Instead of trading 1 share of Tesla, you can control 100 shares, and it's easier to use options on small accounts. Anyway, I think that's a conversation for another day. But even if you've got a large account, it's more capital effective and you get lots of benefits. So the option for me is capital effective. I'm still going to use the same entry, the trigger price. I could look at a stop loss and I can look at the target in the same way. So if I am going to trade with an option instead of the stock, I've got an extra step to look at. And I want to know, what will my option be worth if this stock goes to target? So I can still enter my option around here. And if the stock moves favorably and goes to $80, I'd like to know what my option's worth, because I'm not going to get the full amount of the stock price because I'm not trading the stock, but I am going to get a proportional reward. So let me just go back one. I think I actually skipped over. So if I have that $500 risk, it goes to targets, it's going to be, the stock this time will be $2,500 profits. However, if I go to the option, and I'll show you how we work this out in a moment, I've still got the $500 risk, but I'm not going to make the same dollar amount. It's close, but it's not the same. It's going to be a little bit less. So if I'm right, I get about 80%, 70 to 80% of the stock move transferred into my option. Does that make sense? Let me just pause it. Does that make sense? If I'm right and the stock does what I think it was going to do anyway, with the option, I get about 70 to 80% of the value of the movements, the stock movements, that's what we're talking about, that gets transferred into the option. So I can make a similar amount, but I'm able to save on the capital so I can trade more frequently. So it's not the full amounts, I get a proportional amount, and that's the important part. So the other thing that's worth noting as well is I'm not holding the trade to expiration. If the option does what I think it's going to do, I'm going to close the trade. I'm going to sell it back to the market and cash out, just like you would do with a stock. If the stock went from 55 to 80, you're going to close the trade and take the profits. The same with the option. If the stock does what I want it to do, then I'm going to close the option for a profit. It's the same thing. So I'm using the option as an alternative to trading the stock. Now, the extra step, where did I get the $1,700 profit? How do I know that that's how much money I would make? Now, on most goods option brokers, I can get access to an analysis tab, an option analysis. And this pretty much is standard on most. Mine looks a little bit fancy. This is on Tastyworks. It's got a nice user interface. Most of them don't look this pretty. Just be aware of that. But what we have is a way that I can visualize what the option is worth. So this is the option analyzer. So down the center, let me just explain what we're looking at. Down the center is the stock price. Just like we looked at the charts, you know, up on a stock chart, up on the right-hand side of a stock chart, we've got the stock price. So this is now down the center. So if the stock goes down, I will lose money. If the stock goes up, I will make money. So what I can do is I can look at my entry again, just so we've got them compared. Again, what I'm going to do, so you can see, we're going to look at where all these points are, the entry, the stop, and the targets, and what it looks like on the option. So we've got our entry price at $55. So I'm reserving 100 shares at $55, and it's going to cost me about $5 per share. I've got my target, and we can see that right there. So my target is $80. So if I move the crosshairs over there, then this little data window pops up right there that I'm highlighting now. That little data window appears, and I've got a couple of numbers there. I don't really want to overcomplicate it by explaining each element there, but it tells me if the stock goes to $80, and let's presume that all the time that I purchase, so if I buy a 90-day option, I've got 90 days for this to get to $80. I think that's going to happen. So if in 90 days time, the stock goes to $80, then I'll make $1,700. That's a pretty good. So that's how I've worked it out. It does it for you. I don't need to worry about it. So I'm going to risk $500. If the stock does what I think it's going to do, and I use all the time that I've got, I'll make $1,700. If it gets there faster, if it got there tomorrow because of a news announcement or just a general fast move, which is what we see at the moment, then I'll probably make a little bit more. But worst case scenario, if I use all of the time that I've purchased and it's at the $80 level, then I'll make the money that I wanted. I won't make $2,500 like I was making with the stock, but I'll make $1,700. I think that's close enough. And the other benefits are I don't need a traditional stop loss. Let me say that again. I don't need a traditional stop loss because my risk is managed on the entry. So this is one of the big differences between trading stock and trading an option. And what we've done is we've used the full price of the option, the deposits, as my risk. So my risk is $500 because the option price was $500. And it doesn't matter if the stock takes a swan dive. If this turned out to be an Enron, if anyone's old enough to remember Enron, but if this turned out to be an Enron, or there's another stock market crash tomorrow, and this goes from $55 down to $1 tomorrow because it turned out to be a lame duck, it doesn't matter because my risk is fixed on the entry, the price of the option. Let's put this in the real world. If I was to buy a car and I reserve my car, I've left my deposit with the car dealer. If it turns out to be a bad car dealer, a ringer, it turns out to be an awful car, the worst case scenario is that you would lose your deposits. Now, with the car dealerships, you usually get your deposit back. But what if they disappeared tomorrow? The worst case scenario is you lose your deposits. It's the same with a stock option. The worst case scenario is you lose your deposits. And this is another attraction for me. This allows me to sleep at night. This allows me to not stress over what the market's doing. And because I've got this capital saving, I can go and put other trades on. I've not got a margin requirement. I've managed my trade on the entry. Worst case scenario is $500. If this stock was to take a swan dive tomorrow and it was $1, and it loses 99% of its value, yeah, it's okay. I've only lost what I said was acceptable to lose in the first place, my $500. Now, I don't want that to happen. I don't want that to happen, but that's the worst case scenario. And that gives me a huge measure of peace of mind. So I don't need the traditional stop loss because, again, I want to emphasize this. I really want to send this home. My risk is managed on the entry, and unlike stock, which is managed on the exit. If the stock moves down, then it's managed on the exit. So there is a chance, it doesn't happen often, but there is a chance that my stop loss could be skipped. It gaps, just like it did here. If my stop loss was there and it gaps, instead of risking $5, I could be out for $15 because that's what happened right there. The stock gaps. You don't have to worry about any of that nonsense. There's no stressing over where a position or the market will be tomorrow. So again, just reinforcing, these are reasons why I like trading options. Now, the caveat to this is if I did want to use a traditional exit and use options as an alternative to stock and have that traditional stop loss exit. Now, I don't trade this way, but I'm just pointing out it's possible. Instead of trading one contract using the full premium of the option, I could trade, in this particular case, I could trade two contracts for the same $500 risk if I was to use a traditional stop loss. So if the stock went down to $50, just like we would do with the stock, we would close the position, or we would hope to close it for our $5 loss. I can do the same thing with the option. If it goes to that traditional stop loss level, I can also close the option. Now that means if I'm going to do that, my same $500 risk, I could trade two contracts with the way that it works out. Let's take a look at what that looks like. So let's go back to our graph. If I was to trade same $55 entry, now this time I've got two contracts loaded up. There's our $80 level targets. And there's our data window that says now for the same $500 risk, assuming that I'm going to manage it with a traditional stop loss exit, I can increase my position size. So for the same $500, that now becomes $3,300. So now trading options is for the same $500 risk is going to make me more money if I was to trade it in the same way as the stock. Let me say that again. For the same $500 risk, and if I was to trade this setup in exactly the same way that I would do with a stock position, by simply moving to an option position, I'm going to make more money. Instead of controlling 100 shares with $500 risk on the stock, I'm now controlling 200 shares with the same $500 risk on the option and trading it exactly the same way. So I've now got the potential to make $3,300, which if we can all do the mental math very quickly, I'm just stalling to take my shoes and socks off. It's $800. I'm going to make $800 more because I'm making better use of the money that I have available. And again, this all assumes that the stock goes to $80 in the time that we expect it to get there. It's the same trade. And if it gets there faster, I'll make more. If it gets there faster, I'll make more. So I don't normally do that because it means the trade-off with this is I've got to have a stop loss. I've got to trade it like the stock. I would rather manage my position on the entry than the exit. And I'm prepared to sacrifice the extra gains that I could make for the peace of mind and a good night's sleep. Does that make sense? So that's what this is what you can do. You can double the money, essentially. You can double the position size. You can make more money, or you can sleep at night. Choice is yours. I want a sleepless night. Sorry, I don't want a sleepless night. I want peace of mind. I want to sleep like a baby. So dealer's choice. It's whatever you want. Some people like to do the contract multiplier. Some people like to do a good night's sleep. That's what I like to be. Again, 27 years later, this is what I prefer. I've done it both ways, but this is the one I prefer. You're risking $500, manage it on my entry, and don't worry about it. I don't have to manage the loss. And I think that's an important thing. This is one of the things that we mentioned a couple of weeks ago on how do we, when we looked at 27 years later, how do you have a long multi-decade career at this? It's managing my ability to sleep at night is what's allowed me to have a multi-decade career at this. We can do it, the other way. But the trade-off is you've got to manage the trade on the exit. And I would rather manage the risk on the entry. Manage the risk on the entry. And this is one of the advantages for me. So let's wrap it up. Let's land this plane, as the kids like to say. Stock versus option. Same risk, $500. Same risk, $500. Where's my little drawing thingamabob? So the same risk, $500. Same risk. Rewards, $2,500. The way I like to do it is I'm going to make a little bit less, but it's not much difference. We could, as we just saw, turn that into, what was it, 3,000. 3,300. So you could make more if you do that contract multiplier. I don't like to do that. That's personal preference. There's nothing more than that. Margin requirements you have on stock. You don't have a margin requirement on the option. The risk is the cost. The cost is the risk is the cost. Let me do it one more time. The cost is the risk is the cost. There's no margin requirement on the option. Now, the stop loss, as we said there, can be skipped. If it turned out to be a donkey and it turned out to be Enron, you could end up owing the broker more money. If you use margin in a silly way and the stock moves not favorably, you can end up having a margin call. I've had one of those in my life. It was the most unpleasant, uncomfortable conversations I've ever experienced. And I vowed to myself never to have that experience again. So stop losses can be skipped. So be sensible is all I'm saying. You use margin as a discount instead of a multiplier. The downside to the option is you are on the clock, but no stops are required. So you are on the clock. You've got a time element in there. We've spoken about time. I think we spoke about time last week for the premium, but there's no stop loss required, as we've mentioned. So that's what I like. That's the way I like to trade options. The bottom line is it's more capital efficient. It's more capital effective. And again, as I mentioned earlier, this is just one of the 5 main strategies that I like to. This is the first one I teach all my students. And it is part of the production line trading process, which, as far as I'm concerned, is the smartest way to swing trade stocks. We have a mechanical scan, a visual confirmation. And what we've kind of spoken about here is this profitable trade framework. That, that's kind of what we focused on today. Is we've looked at, okay, well, now we found a trade. Now we've got one that we like. How do we put the trade on? I like to use a stock option. Just to answer your question, Lloyd, am I doing a spread or a single option? It depends on the situation. Personally, I use a straight single put or a single call straight option, Lloyd. So it's a stock replacement strategy in that regard. It's not an accurate stock replacement strategy, but it's just my version of it. You can use a debit spread if you want. That is one of the 5 strategies I teach. You can use debit spread, credit spread, and there's some other strategies that we can use to manage the trade. But at its most basic, the first thing that you would probably want to learn is, okay, instead of trading stock, how do I step into the option world? So this is the first thing that I teach all my traders. And then you can, after that, the second thing would be, if you can't afford the $500, maybe you're at the small account spectrum, then that's when you would say, okay, well, I've got the trade. I like it. I can't afford a single call. I'll do a debit spread. And again, I've got a blueprint and a roadmap That's the second strategy that I teach all my traders. Anyway, so that's what we focused on today. So we focused on the one of the trade frameworks that we like to use. And again, the reason why I keep talking about this, it means that, you know, I'm not zombie trading. I'm not flicking through chart after chart after chart. As you've seen there, I've got a pretty standard production line for the option strategy as well. It gives me time freedom, financial freedom. We want to have a trading plan. We want to trade small size. And by using the option, this is what I was talking about earlier, it allows me to trade frequently, because if I'm freeing up my capital because I don't have a margin requirement on the stock, then I can naturally trade more frequently. I've got more funds available to trade frequently. So when you trade small with it could be a call, it could be a debit spread, you can trade small position size. If you just want to trade with $50 risk, you can trade with $50 risk. And that's really going to allow you to trade frequently and free up your ability to profit from a portfolio of trades. That is my style of trading. I teach portfolio trading. I do teach a portfolio of stocks and a portfolio of strategies. So if you want some extra help with any or all of the things that we've discussed today, I do have a mentorship program. Production line trading, as I keep saying, it is the smartest way to swing trade the stock markets. I refer to what I do as a production line. It's intentional. It allows me that time frame that I mentioned. You know, after this call, I've got a private session, and then I'm going to go and do something else for the rest of my day. I've got things to do. I've got ice cream to order. I've got urban rambles to ramble. I've got free time, and I appreciate that. I'm very fortunate. Now, it wasn't always this way, but it really is because I cracked the code. All I'm trading is the best stocks and the best patterns. I'm not trying to trade every stock every day all the time. You've heard me in the last several weeks. I'm just trading at the moment my top 50 stocks. My universe of stocks is about 350. I'm not trying to trade everything every day all of the time. And what we looked at today is part of the TTE management system. Is you know, how to initially go from a stock trade to an option trade. The first strategy that I teach everyone is what we looked at today, and you should be able to do this in 10 to 20 minutes every day. And if it takes you 2 or 3 hours, there's something wrong. There's something wrong if you're spending 2 or 3 hours doing this. And it gives you confidence. You can walk away. You can go and do things. You'll transition into the best possible trader that you can be. You will never be a zombie trader. You won't ever be flicking through chart after chart after chart, wondering if the next trade is the one. You will never be doing that stock market equivalent of where's Wally. It's not pleasant. We just want to be able to zero in on the best stocks today. And if you can tell by my whimsical attitude today, you won't be stressing. It doesn't matter what the market's doing. The markets have been absolutely flatlining in the last couple of weeks. And when I'm talking about the markets, I'm talking about the indexes. The indexes, which we'll look at in a moment, have done absolutely sweet Fanny Adams. It doesn't matter what the market is doing, because the markets, the indexes, are not the trades that we're placing. They give us a guide as to what the kind of the overall pulse is, but we don't need to worry about what the market's doing. In fact, we'll profit whether the market goes up, down, or like we've seen in the last several weeks, it's going nowhere. It doesn't matter. But there's individual stocks that set up all the time. And that's because we're focused on the best stocks, the best patterns, my top 50 or top 350, depends on where you are. You won't be reading boring company reports, trying to figure out if there's any value. I'm not Warren Buffett. I'm not trying to value invest. I'm trying to profit from the swings in the markets that last for 20 to 30 days, which hopefully explains why I went 90 days with my option. I need 2 or 3 times as much time as what I actually need for my stock option. And this is part of what we actually teach in production line trading. So if you would like to learn more, I don't know if it's right for you. I truly don't know. But what I promise everyone is, if you go to AntiVestor.com, if you check out the extra information, if it makes sense, follow the instructions and book a call and let's talk. If it is right for you, we'll figure out what the next steps are. If it's not, that's okay as well. I'll always point you off in the right direction. So that's my promise to you. And with that said, that was Option Strategies 101, the first one I teach all my students, made simple. Let's go and find some awesome trades. Where's my thing? While I'm doing that, folks, I'm just going to take a moment just to have a slurp of my tea. What do you think? Does it all make sense? If options are new for you, does that make sense? I'll answer your question in a moment, Adrian. I'm just stalling so I can just take a quick drink. Does trading options seem less scary now? Does trading options seem less scary now? Does it make sense? The first strategy is to replace the traditional stock trade with an option. And that's how I do it. An at the money option. Easy peasy, lemon squeezy. Awesome. Thank you for your feedback, Randall. Thank you, everyone. Oh, right. Oh, another slurp. I didn't realize my throat was parched. A nice cup of Tetley. There we go. If you're not in the UK, that won't make any sense whatsoever. So, question from Adrian. Is it time to get back into Logitech? One of the things that we focus on is trading the trend. It's one of 6 ways that I teach to trade, 6 market trends. And the one that we keep looking at every week is Logitech. In fact, let me go back to Twitter. This is our model trade. And you hear me say it week in, week out. Does it look like Twitter? Does it look like Twitter? Does it look like Twitter? So what are we looking for? This does answer your question, or it will eventually answer your question, Adrian. Adrian was asking, is it time to get back into Logitech? Is the dip over? Well, I can answer the second part to that. Is the dip over? I don't know. No one knows what's going to happen next. But I'm just going to remind us, what are we looking for? So the fact that we're asking the question, Adrian, is telling me that you need definition on what you consider the dip is, the retracements. That's what we're going to go through now. Every week we do this. My average prices are crossed up. That gives me the broad market direction. The broad market direction. The average prices are going up. Now, to help avoid the whipsaws, the false alerts, the false starts, I want to make sure that that average price crossover has been in a trend or has been crossed over for about 40 days. That's 2 months if you take the weekends out. About 2 months. So that takes me to about here on the chart. Then we want to see in that period that the stock is going up. The number doesn't really matter too much. Just confirm that it's going up. Now, the way that we do this in real time is we look backwards, usually about 60 days, and say, has this stock gone up? Now, all of this can be done in the watch list on well, I've got it covered up at the moment, but we normally look at that on the watch list, but this is just what we're looking for right now. Now, we can scan for this. We can scan for these things as well and go and look in our top 50 stocks or top 100 or top 250, whatever your number is, and find these opportunities. We'll do that in a moment. But what we're looking for, so that's step number 1, average price crossed over. Step number 2, it's going up. 3, it's in that trend. And what we're looking for is number 4. We're looking for all the times that price is retracing. So this comes to your question, Adrian. What do we call a dip, a retracement, a correction? There's lots of ways of saying the same thing, but at a bare minimum, we can say 10% in 10 days. That's the first thing. Or we can say it's below the 20-period moving average or below the 50-period moving average. So these lines, I should have started with this. These lines here, there's the 20, that one there's the 50, and that's the 20-period. So we've got 3 moving averages, the 20, the 50, and the 200. So when price is trending, we can see that price comes below the 20, below the 50. It comes below the 20, below the 50. It comes below the 20, below the 50, below the 20, below the 50. Now, if it doesn't do that, below the 20 or below the 50, then we can look at, has it retraced 10% in 10 days? So there's 2 ways. Now, usually it's both of them at the same time, but sometimes it's not. So we can use one, the other, and most of the time it's both those things, those retracement conditions. So that's what we're looking for. This is what, for me, buy the dip. Now, let me pause here. Does this make sense? I've defined exactly what buy the dip means. I've defined the trend, what that means to me. The tools don't matter a great deal. We've very whimsically, I went on a major rants and tangents last week about this. all the tools are to help us with a structure to identify these things. So we're focusing on the classic trend using the average prices. Last time, average price is up in trend for 40 days. Visually, it's going up, and we're trying to find the dip, the yellow boxes. And this is why I keep saying, does it look like Twitter? Does it look like Twitter? This is one that didn't work, would have got you in, stopped you out. But you know what? It's down to the 200, and we've spoke about that in real time as it was happening in the last few weeks. It's going the right way. That was also our example earlier today as well. So these are all things that we can four stages, 4 steps that we can use to find opportunities. We can also use it to analyze a chart. So let me just go through the scanning, and then we'll go and look at analyzing Logitech to try and answer that question. So what we can see here is there's a few blue and red boxes. I have had this custom coded just so that it's more appealing. I'm a very visual trader, if you can't tell by the way I do things. But this column here that I'm just highlighting, this column here, this is telling me that the average prices are either bullish crossed or bearish crossed. And then the next column tells me how many days it's been in the trend. So I can see at a glance. So for example, this Tupperware row here, it's a bearish trend, and it's been in that bearish trend for 22 days. It's not been in a bearish trend for 40 days. So I don't need to worry about it right now. It's an interesting stock for me, but it's not been in that bearish state for 40 days. So most of these are all bullish stocks, and they're in at average price. I can also look at these next 3 columns, and what they're telling me is, where is price in relation to the moving average? So if it's blue, it's above the moving average. If it's red, it's below the moving average. So from right to left, we've got 250 is the middle one, and the left one is the 20. So I can see where price is. So here's a good example. So WDC, if I just highlight the row above it, so WDC is just below that white row that I've highlighted. I can see that we're below the 20, above the 50, above the 200. We're in a bullish state. So price is, for that to happen, price must be retracing. Now, what it doesn't have is this column. This is a built-in tool. This tells me what happened in the last 10 days. Is it up or down in the last 10 days? So I can find all these things out, all these markers that we were just talking about in regards to Twitter. I can do all of that heavy lifting. So that's how we would scan on the left. But we need to know what we're looking for. I need to know what the blueprint looked like. That's what we're looking for. But we do all of that over here on the left. Now, when we've decided that we're looking at a chart, so come back to your question, Adrian. So that's what we're looking for. That's what we're doing with the classic trend. So to answer your question, is the dip over? You were asking about Logitech, L-O-G-I. Let's look at that. So you tell me, is the dip over? I'm just going to put Logitech in the tool list. So this column here, that is in the last 10 days. If I just highlight it for you, in the last 10 days, that's that number there. So have we retraced 10% in 10 days? The fact that it's blue tells me that although it's down for the last 2 days, it's still up 10% in 10 days. So it's not met that first requirement, has it? It's not met the first requirements. It needs to be down 10% in 10 days. So the 10% in 10 days, that first criteria, the dip, is not being met. So the other way that we can measure a dip or a retracement is it below the 20 or the 50 period moving average? So there's the 20 period, there's the 50 period, and there's the 200 period. So we've got a trend, long-term trend. It looks awesome. Price is moving down for the moment, but it's not meeting our 10% in 10-day criteria. Neither is it below the 20 or below the 50. So it doesn't meet my definition of a retracement. Now, the second part to your question, Adrian, is it over? Is the retracement over? The most honest answer I can give you, Adrian, is I don't know. I don't know what's going to happen next, and no one knows what's going to happen next. And this is one of the major difficulties that newer traders get hung up on, is the need to be right, the need to know what's going to happen next. And the future is quite literally uncertain. I don't know is the answer. I'm not going to try and blow wind in your sails to say, I know exactly what's going to happen. I can give you the benefit of my experience. I can give you my opinion, but I truly don't know what's going to happen next. So I can only control the things that I know. So what do I know? I know that the average prices are crossed for a long time now, 277 days. So it meets that grid requirement. We've got the average price bullish in trend for 270 days. In the last 90 days, we're up 30%. So we're looking great. And all that information's there. I'm just looking at that row on the left there. So I know all of this information. It's still rallying in an uptrend. So I'm going to, although it's down 1-2 days, it's not down 10% in 10 days. Neither is it below the 50 or below the 200. Now, it might be that that's as far as it retraces. It doesn't go any lower. And this is the trick. I've got to be okay with not taking any retracement. I've got to wait for my retracement. My retracement, my definition is 10% in 10 days or below the 50 or below the 20-period moving average. So it needs to be here. It needs to be below $120. And if it's not there, it needs to have been down 10% in the last 10 days. It's only down 0.6% in the last 3 days. It's not actually down that much. Does that make sense? I think this is an important distinction to make when we're looking for trading opportunities. Is the hardest part about all of this is waiting for your entry criteria, your alert criteria, your setup criteria. And it's that FOMO, because Logitech's a great stock. It's a great trade. It's a great trend. Historically, this is one of my favorite stocks. And I've got to be okay with not getting in today or tomorrow, or maybe even next week. I've got to wait for my setup to develop, because if you don't wait for it, what was the point in having a strategy in the first place? Yeah, what was the point in having a strategy? If you're not going to wait for your setup, if you're not going to wait for your opportunity, then what was the point in all the research? Because I've spent quite literally decades crafting and honing and fine-tuning and waiting for the best opportunities. And one of the things that I've relearned recently is, let me just come back to, is we mentioned this last week, stay in your lane. Wait for the opportunity. The data is proving I don't need to fuck around. Why would I want to take the chance on missing the setup because I want to put the trade on now because I'm scared that I'm going to miss a trade? The data is saying, don't worry about it. Your time will come. Wait for the setup. Wait for it. Because if you're doing anything that you've not defined as part of your strategy, you're going to lose money. You're going to be just like everyone else. You're going to be doing, I'll tell you what you'll be doing. You'll be doing this. You're going to be that zombie trader sat in front of the computer, flicking through chart after chart after chart. And if you're in that trade, you're going to be babysitting it. You're going to be looking at it. You're going to be watching it like a hawk. You're going to be watching every price movement, every price fluctuation. You're going to be looking at the P&L going up and down, up and down, up and down like a yo-yo roller coaster. I don't want that. I don't want that. So this is why I keep talking about this production. Get absolute crystal clear clarity and definition on what you're doing, what are you waiting for, and then wait for it to happen. And that last part is what separates my 27-year career with most other traders who can't make it work because of the FOMO, because they are not waiting for the right opportunity, for their setup to develop, or maybe they just don't have that clarity on their setup. And you all do. You've all got my favorite setup, the buy the dip. You've all got my criteria on what buy the dip looks like to me. So the hard part is the waiting. And this is one of the brilliant things about what we do. If you can be patient, money will come to you. You don't have to go looking for it. You've just got to sit there. You've got to be patient. The data proves it. Here's some, just to go through some of our, where are we? Just to go through some of our trade ideas. We can, you see, like, this is Steel Dynamics. We can trade the trend. We can wait for the dip. We can buy it. We've got to wait for our opportunity. And I know that if we just wait for the setup, we're going to get some steady returns. But just placing any trade because we're worried about missing the move is a fool's errand. We're going to suddenly be not following the system. And yet the data right here is saying, if you just wait for the setups, you're going to make some money. If I do nothing else other than trade signal to signal, which is the worst version of any strategy, I'm going to make some money. I don't have to think about this. So interesting stocks. Tesla looks awesome. Apple looks awesome. NVIDIA looks absolutely awesome. But they're not today trades. Avis, okay, I did mention this in our community. Mentioned it last week as well, actually. Avis is starting to move. This is as close to a today trade as we can find. I can't remember what the ticker symbol is. I was just looking at it. CAR, there we go. CAR. I've mentioned this a few times in the last few weeks, but this is for me looking great. So let's now. So let's go through our production line. Bear with me a second. Let's go through our production line. I've been watching this scanned up for us. Where's my? Bear with me. Okay, so this scanned up for me a couple of weeks ago. So mechanical reason to look at the chart. Mechanical reason to look at the chart. Let's go and look at it. So mechanical reason to look at the chart. The average prices are going up. It's been in a trend for at least 40 days. Visually, we can see it's going up now. We're looking at it. And a couple of weeks ago, it went below the 20-period moving average. So that's what put it on my watch list. So that's the mechanical reason. And we would have seen that over here on the left in the watch list. Mechanical reason, it's going up, it's in a trend, it's retraced 10% in 10 days, or it's below the 20-period moving average. That happened right there. So I've been watching this for a couple of weeks. So that's what put it in front of me. That is the mechanical reason to be looking at the trade. Mechanical reason. It's a repeatable, replicatable process to find, filter, and sort stocks. That's that step. That's what I'm showing you pretty much most weeks. Now we're looking at this chart. This is what we just did with Logitech. Visual confirmation. We want visual confirmation that it's doing the thing that we want to do. Well, now we're looking at this chart. Yeah, it's going up. Visually, we can see that it's in the trend. It's been retracing. But now we're looking at it. You can, let me just zoom in. Now we're looking at it. We can see, well, actually, I've got something a little bit extra. This is what I like to call an O and. Oh, and so it's doing all the things that I want. It's in trend. It's going up. It's retracing below the 20-period moving average, but it's also creating this really short-term consolidation. Everyone can see that. It's developing a short-term consolidation. Got this lovely flat high base there. Got rising lows, and we can call this an ascending triangle. So this just made me wait to place the trade because I've got an O and. Now, this is something that I bring to the table. This is my secret blend of herbs and spices. This is the bit that I can't code. So this just made me wait temporarily. It's not no, but I'm going to wait for price to move above the range high because it's doing what we've referred to in the past as a time retracement. It's rallied and it's just being paused. So I'm going to wait for that retracement. Can we all see there that it's now gone above the high? It's above $90. That's what we call a pullback. Rallied, it's retraced for 1-2 days. We're really close to the moving averages. So we're not in rally modes. We're waiting for what we call a breakout of the consolidation. That's what it looks like in real time. Entry above the pullback high, go long, get long, come back in a month and see how much money we're making. So this is what we've been following for the last couple of weeks. So here's a live one. Here's a live one. CAR, Avis Budgets Corp. It checks all the boxes. This is what trade the trend or buy the dip looks like. This time the dip, it meets our requirements, but we've got this little visual override. And this is why we have, let me go back to the slides. This is why we have that step. Because I spotted something that I recognized. It's not critical. It's not essential. It just means that, like, does the chart look like I'm expecting it to look? I'm expecting it to look like Twitter. Does it look like Twitter? Yeah, pretty much did. So then I can apply my profitable trade framework that we just went through. Look at my entries, my exits, my stops, my targets, and I'm going to use a stock option to place my profitable trade. It should last 20 to 30 days. And I'll find out in 20 to 30 days if we're going to make money. So here we go. I was asked last week for a live one. Yeah, Ezekiel's asking, would CAR have been a legitimate entry for everyone else if there was a no answer? I'm actually getting a little bit later. I'm actually getting in a little bit later. You could have got in, somewhere around there. You could have got in around there. There's only a delay of 2 or 3 days. Really, it's just because I recognize it. It's not critical. It's not essential. The O and is, I happen to recognize something. If you don't recognize it, that's okay as well. You probably would have got in somewhere around $85. You probably would have got in a lot earlier. So my O and meant that I got in later. So it didn't do me any favors, Ezekiel. It's just, that's what I saw. So if you'd not done that and price was starting to move above the moving averages and it was looking like it was starting to move, you probably would have been in about $85. It's meandering sideways for a day or 2 or 3, and now it's taken off. So my O and didn't do me any favors. So if you just got in as price started to turn around, you would have got a better entry. You would have been sitting in a nice $7 profits, and you wouldn't be worried about it. So it's not a case of the O and part. It can be a help or a hindrance. And I think on this particular trade for me, this is the curse of knowledge. It was a little bit of a hindrance, just because it just made me delay my entry. Sometimes it works the other way. It's going to keep me out of a trade that doesn't quite work the way that I think it should work. So this one didn't do me a favor. On a different day, on a different trade with a similar setup, it's going to be a brilliant addition to the trade. The extra step, the extra flavor. And again, it's not critical. If you're at the newer end of your trading career, it's not critical. It's not essential. It's not a deal breaker. It's not that I'm not going to place the trade. It's just, I might just do something a little bit different. It could be that, I recognize a wave 5 Elliott wave. I don't know. I don't trade Elliott wave. I'm just making it up. But maybe you really like Elliott wave and you've discovered in your research that, wave 5 is the strongest, hardest, biggest, the best, the baddest. It offers the fastest moves. If that's your research, then and you recognize that, maybe you're going to place the trade anyway, but your O and in this made up example is, and there's an Elliott wave 5 setting up. Great, cool. Maybe I increase my position size. Yeah, just reading your comments, Ezekiel. Yeah, the curse of knowledge. It's it can be a good thing or a bad thing. Perfect. There's lots of make senses there. So it's not critical. It's not a deal breaker. It's just you might decide to manage the trade a little bit differently. That's these days. That's how I tend to deal with it. You might manage the emphasis is there. You might manage the trade a little bit differently because you recognize something that you're familiar with. It could be, for me, I've traded years, consolidation patterns. I spent 12 years just trading consolidations. So I bring something extra to the table. It's discretionary. I can't quantify it, but it's not essential. I know it's not essential because we've codified about 90% of what we do into an algorithm. So I don't need to do it, but it satisfies that human itch to do something. I'm going to place the trade anyway, but I recognize this and I might delay my entry a few days. I might increase my position size. I might reduce my position size. I don't know, but it's not critical. I've got a default stance that I'm going to place the trade anyway. I know exactly where that is because we've got a mechanical checklist to take me through that. So if I don't see anything, trade sets up, trade goes on. And that might be a great place to draw a line and finish the session. Just a few minutes. Oh, right on time. There we go. So production line trading, that's what we've done. That's what we've looked at. The primary focus of our educational elements was options strategy made simple. And we looked at what I refer to as a stock replacement strategy, or my version of a stock replacement strategy. And hopefully it should be, options aren't scary. And you've seen why I like to use them. For me, they're more capital efficient. They're more capital effective. And from time to time, you'll actually make more money just with the way that you can set up a trade. And when you get into some of the more exotic sounding option strategies, you will make more money than stock, because we've got so much freedom and so much flexibility with a stock option than we have with straight up stock. That's my viewpoint. That's my opinion. Other people have different viewpoints and opinions, but I'm a product of my own success. They've been very good to me. So I would encourage everyone to look into them. I know people who have and prefer to trade different ways, and that's okay. You've got to find your own foot. This is the way I do it. And hopefully you can introduce it as a part of how you do it. So thank you for your time. Thank you for your attention. Have a wonderful weekend, and I'll see you all at the same time, same place next week.